I'm not suggesting to you, Anthony, that the gold price rises 26-fold from here. It's already done very, very, very well in the period 2000 to 2026. What I am suggesting to you is that gold will maintain its purchasing power over the next 10 years, while the US dollar will lose 75% of its purchasing power, which is to say that the nominal value of gold, if the silver price went up, I expected the silver stocks to keep pace at least with silver. And if the silver price went down, given the fact that the silver stocks were discounting $45 silver, while the price action might be ugly, the change in value wouldn't be precipitous at all.
Investor attention is returning to precious metals, with gold preserving purchasing power and silver providing high-reward opportunities. Strategic central bank moves and market inefficiencies continue to create openings for both long-term and tactical positions. A seasoned investor in precious metals, Rick Rule, explained that the strong rally in gold during 2024 to 2025 was largely a release of pressure that had been building for years rather than a reaction to new developments. In his view, the same conditions driving the surge, such as massive government debt, fiscal imbalances, and growing geopolitical tensions, had already existed long before the market recognized them. He also pointed to the geopolitical shift created by the freezing of roughly $300 billion in Russian reserves and the broader weaponization of the US dollar and the global financial system. These actions encouraged foreign central banks, which had once been net sellers of gold, to become significant buyers. Because of this, he believes the recent price surge mostly reflected a catch-up move rather than the start of equally dramatic gains ahead. Rick Rule still expects gold to perform well over the long term, but he sees its role primarily as preserving purchasing power rather than delivering explosive returns. He argues that unless the United States resolves persistent deficit spending, addresses its massive unfunded entitlement obligations, and restores real interest rates above the rate of currency depreciation, the purchasing power of the US dollar could decline by about 75% between 2025 and 2035. In that scenario, gold would likely rise in nominal terms as the dollar weakens. Reflecting his cautious approach, Rule sold about 25% of his junior mining stock holdings in 2025 to recover his original capital investment, effectively eliminating his downside risk while still maintaining large positions in the sector, senior mining companies, and physical gold for the long term. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying close attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
My view on those is unchanged since the last time we talked. I think the incredible move that we saw in 2024, 2025 was rear-looking, not forward-looking, meaning that the same set of circumstance that was present in 2024 when people took notice was present in 2018 before people took notice. And I think that you had a gold market coming into 2024 that was literally a coiled spring. And I think the price action that we saw in 2024, 2025 was releasing tension from that coiled spring. The spring wasn't all about the lousy arithmetic of U.S. on balance sheet and off balance sheet and other countries' balance sheet problems. The spring also had to do with the weaponization of the U.S. dollar, the stealing of $300 billion worth of Russian assets, irrespective of your belief in what Russia did in the Ukraine, and the weaponization by the U.S. government of the SWIFT banking systems and other places. What this did is create real demand for gold from a source, foreign central banks, that had been until 2015 or 2016 net sellers of gold. That was a big turnaround. And I think that the price action that you saw, the price explosion that we saw in gold in 2024 and 2025, was really backward looking. It was really making up for lost ground. I don't believe that the increases in precious metals prices going forward will be as dramatic as the ones that we've just enjoyed. But I do believe that unless and until the weaponization of the US dollar is discontinued, and until the United States finds a political solution to deficit spending, and until a political accord is reached that eliminates the danger of $120 trillion in unfunded entitlement promises in the United States. And until we have a real interest yield that is above the rate of deterioration of the US dollar, that the value, the purchasing power of the US dollar declines. I believe specifically, as I have said numerous times, that I expect in the period 2025 to 2035, the purchasing power of the US dollar to decline by 75%. There's historical precedent for that. In the decade 1970 to 1980, the purchasing power of the US dollar declined by 75%. And not coincidentally, in that same decade, the gold price ran 26-fold. I'm not suggesting to you, Anthony, that the gold price rises 26-fold from here. It's already done very, very, very well in the period 2000 to 2026. What I am suggesting to you is that gold will maintain its purchasing power over the next 10 years, while the US dollar will lose 75% of its purchasing power, which is to say that the nominal value of gold, the value of gold priced in US dollars, will increase, perhaps commensurately with the decline in purchasing power of the US dollar. Now, people who have a shorter term time frame, people who are more speculatively inclined than I, might not want to look at a gift horse in the mouth. The market, both the gold market and the equities market, precious metals equities market, in 2025 were the third most generous to me in my career. And in fact, had I been younger and more aggressive, the moves that occurred in 2025 would have made it the best year in my life. I was more of an investor in the space than a speculator. And as a consequence of my caution, I did less well than a younger Rick would have. That notwithstanding, the gains were extraordinary. And some people might book those gains. As you may know, I sold 25% of my junior mining stocks in October of 2025. Not because I didn't think that the sector would do well. I've already explained the arithmetic of the next 10 years from my viewpoint, but merely because by selling 25% of my junior holdings, I was able to recoup all of the capital that I had invested in the sector in the period 2018 to 2025, which is to say, by selling 25% of my upside, I eliminated my downside, and by the way, also paid the capital gains tax. Whether or not this technique is suitable for other people is something that is up to them. But I believe that portfolio decisions are personal, and that was mine. I mean, ironically, the junior portfolio that I sold a quarter of is back almost to my original levels, which is to say those stocks that I sold have gone up substantially. That doesn't trouble me a bit. I had rather large investments in the sector. And I still have very large investments in the sector, but I have no net risk in the sector. That to me is an extraordinary trade. It's worthwhile noting that some of the money that I took off the table selling the junior mining stocks went back into the seniors, which I perceived as having less upside but less downside. And some of it went into physical gold, which has done reasonably well. But those weren't really tactical allocations. I was just allocating risk to reward based on the arithmetic I see in markets over the next 10 years.
Rick Rule described his approach to silver as part of the speculative segment of his portfolio, which he divides into three categories: savings or insurance, gold and cash, investments, high-quality mining, oil and gas, and conventional financial stocks, and speculation. Having purchased physical silver years earlier when it was widely unpopular, he saw the shift in market sentiment and the rise of silver's prominence alongside gold as opportunities to realize gains. When silver's price exceeded his expectations in a parabolic move, he sold roughly 80% of his physical silver, redeploying about half of the proceeds into silver mining stocks. He reasoned that these stocks were undervalued relative to silver, priced for a $45 silver market while actual prices were much higher, creating the potential for significant upside if silver held or rose, while limiting downside if silver declined. Rule also highlighted the practical advantages of trading certificated or exchange-traded silver over physical bullion, noting the efficiency and lower transaction costs compared with the wide bid-ask spreads in physical markets. He emphasized that most assets are no longer truly unloved, with only a small, highly specialized subsector of microcap explorers in politically challenging regions still offering opportunities for exceptional gains. Currently, he has substantial liquidity and is looking for attractive risk-adjusted deployments, but he finds the market constrained. As a result, most of his new capital has been allocated to senior secured debt in major mining and energy companies, acting as a lender rather than an equity investor, given the relative scarcity of compelling opportunities and the elevated valuations in natural resources markets. Let's get back to the interview.
Yeah, I would. And again, when we had that parabolic move in silver earlier this year, I decided to take advantage of it. Silver, physical silver in my portfolio, inhabited the speculative part of my portfolio. My own portfolio is divided into three buckets: savings or insurance, which is part gold, part cash; investments, which is high quality mining and oil and gas stocks, as well as some conventional financial services companies; and speculation. And I had purchased a reasonable amount of physical silver some years ago when silver was very widely hated, betting that silver would become less hated, that as the precious metals market continued and the generalist investor came into the precious metals market, that price leadership would change from gold to silver. And both those things occurred. The consequence of that is, given the reasons that I owned the silver had occurred, and given that the price action in silver exceeded my expectations, I needed to decide for myself whether the allocation to silver I had in my speculative portfolio was warranted or not. And I chose to sell about 80% of my physical silver. And I redeployed about half of that into the silver stocks. A simple review of arithmetic told me that if the silver price held steady at $75 for a year, by definition, I wouldn't make any more money than silver because it traded sideways. But the best silver stocks were being priced in the market discounting $45 silver, which is to say the best silver stocks could easily increase in value, if not in price, by 50% over the ensuing 12 months. And paradoxically, if the silver price went up, I expected the silver stocks to keep pace at least with silver. And if the silver price went down, given the fact that the silver stocks were discounting $45 silver, while the price action might be ugly, the change in value wouldn't be precipitous at all. So it seemed to me, for about 50% of the money that I recovered from selling the silver, that redeploying into the silver stocks was a better, arithmetically, a better speculative decision for me, which is what I did. No, I was looking at the valuation discrepancies between the silver stocks and the silver. The silver that I sold was convenient to sell. The silver that I sold was largely the Sprott Physical Silver Trust. So I didn't have to face the on-market grind, which is to say the gap between the bid and the ask that you see in the physical silver markets. The actual physical silver that I had in vaults and elsewhere, I still have. Increasingly, to the extent that I trade precious metals, I'm going to trade certificated precious metals. I'm going to trade probably the Sprott products because I know them the best. I understand that some people say metal that you don't have in your hand, you don't own. It's part of the system. That's a risk I'll take, because the gap between the bid and the ask in physical markets can be as much as 7%, even for good delivery product, never mind junk silver. But the spread between the bid and the ask on the New York Stock Exchange for the Sprott physical products is often 50 basis points or less. They are much more efficient trading vehicles. Not much is unloved now, I need to say. Not much is unloved. I mentioned earlier in this interview a little tiny subsector, probably not worth screwing with for most people, which is the microcap conventional explorers offshore in countries that most folks can't pronounce. That's probably not an investment strategy that's suitable for most of your listeners because it requires really pretty complete knowledge of exploration technology and a willingness to accept both volatility and political risk that most people don't have and probably shouldn't have. It's something that I've done for 40 or 45 years. It's something that's made me an awful lot of money in past markets. And as you point out, I gravitate towards hate, and that sector is still hated. Looking for opportunities. I have, by my standards, a lot of liquidity I would like to deploy. I'm just looking at an opportunity constrained world. There isn't very many places to deploy. Most of the new deployments that I have made have been purchasing tranches of the senior secured revolving debt of major mining and oil and gas companies, which means, in effect, I'm a prime lender as opposed to an equity participant in these markets. I would like to be able to take better advantage of volatility and risk, but the size of my existing positions, I'm no billionaire, don't get it wrong, but the size of my existing positions relative to my historical norms and the levels of valuation that I'm seeing, as well as the sentiment, which has swung solidly in favor of natural resources, has made allocations of new capital increasingly difficult for me.
Gold continues to serve as a cornerstone for preserving wealth and protecting purchasing power in an environment of currency depreciation and macroeconomic uncertainty, while silver presents compelling opportunities for higher returns within speculative allocations. By carefully balancing holdings across physical metals, mining equities, and debt instruments, investors can manage risk while capitalizing on valuation discrepancies, market inefficiencies, and shifting sentiment. The interplay of geopolitical developments, central bank policies, and evolving investor demand ensures that both metals remain strategically important, offering a combination of long-term stability and tactical growth potential in diversified portfolios. How can investors effectively balance allocations between gold, silver, and mining equities to optimize both long-term preservation and short-term speculative opportunities? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.